All right, let's dive right in. We're going to tackle a question that sounds kind of boring, but is actually super important. How can a simple choice in how you count your money completely change the story your business tells about itself? It really is a tale of two different timelines, and it all starts with one simple question. Seriously, think about that for a second. Let's say you do some work, you send an invoice, and the customer pays you a week later. So when did you actually earn that money? Was it the day you did the work, or was it the day the cash finally landed in your bank account? Believe it or not, how you answer that question is the entire difference between the two accounting methods we're talking about today. So first up, we have the cash method. This is the one that just makes sense right off the bat. It's totally intuitive. In fact, it's probably how you handle your own personal money, right? It all boils down to one simple idea: money in, money out. Yeah, the rule here is super strict. You don't write anything down until cash, actual physical or digital cash moves. You get paid, boom, that's revenue. You pay a bill, okay, that's an expense. The timing is tied 100% to what's happening in your bank account. Now, to make this crystal clear, let's follow a little baking business. We're going to keep the numbers simple. It costs $10 in ingredients to make a cake, and that cake sells for $25, so that's a nice $15 profit. The real question is, when do we get to record that profit? Let's start in a perfect world. On October 25th, our baker buys the ingredients, bakes the cake, sells it, and gets $25 cash right there on the spot. Everything, the cost, the work, the sale, the payment, it all happens on the very same day. And in this perfect scenario, the cash method is, well, it's perfect. The $10 expense and the $25 revenue both get recorded in October. What's the result? A totally clear, totally accurate profit of $15 for the month. Simple, clean. So far, so good. But what happens when the real world gets a little messy? I mean, most businesses don't get paid on the spot for everything. They sell stuff on credit, they send invoices, and this is where a simple little timing difference can create a huge problem for the cash method. So let's imagine the exact same sale. On October 25th, the baker buys the ingredients and delivers that beautiful cake. But this time, the customer says, "I'll pay you next week," and they pay on November 1st. Now, under the cash method, that $10 expense is recorded in October. But the $25 revenue, that doesn't get recorded until November. And here's where the story gets completely twisted. The books for October show a $10 loss. Then, November suddenly looks amazing with a $25 profit. But it was the exact same cake. All the work happened in October. This story is just plain misleading. It suggests you had a terrible month followed by a fantastic one, when neither is really true. And just that one example shows you all the hidden flaws. The cash method can create these wild artificial swings in your results. It gives you a really inaccurate picture of how your business actually performed in a given month or quarter. And, maybe worst of all, because you only record things when cash moves, you have no formal way to track who owes you money. Okay, so if the cash method can tell a confusing, even misleading story, there's got to be a better way, right? How do we get a clearer picture? Well, we do it by using a different method, one that was designed specifically to fix this timing problem, and that is the accrual method. The accrual method basically throws that whole wait for the cash rule right out the window. It totally disconnects the record keeping from the movement of money. Instead, revenue is recognized when you earn it, which means when you deliver the goods or perform the service, and expenses are recorded when you incur them, when you use something up, not necessarily when you pay for it. The entire foundation of accrual accounting, the secret sauce that makes it so powerful, is this one beautiful idea called the matching principle. This is the key to telling the true financial story. So here it is. The matching principle says that you have to match your revenues with the exact expenses that helped you generate them. And this is the crucial part. You have to record all of them in the very same time period. So the cost of the cake ingredients must be recorded in the same month as the revenue from selling that cake. Period. So let's go back to our delayed payment problem one last time, but now we'll use the accrual method. On October 25th, the cake is delivered. That's the moment the revenue was earned, so bam, we record $25 of revenue right then, in October. And on that same day, the ingredients were used to make that specific cake. That's when the expense was incurred, so we record the $10 expense in October too. And just like that, Look what happens. A $15 profit, correctly and logically recorded in October, the month the actual business activity took place. This is a much more accurate reflection of the bakery's performance. Now, that is a story that actually makes sense. So, we've seen two totally different ways of looking at the exact same transaction. Now, this doesn't mean one is always good and the other is always bad. It's all about choosing the right tool for the right job. Let's put them right next to each other. The cash method is all about one thing. When did the money move? The accrual method is about something completely different. When did the business activity, the earning and the spending actually happen? And that one difference changes everything. You can see the big trade-offs right here. Cash is simple, for sure, but that profit picture can get really distorted. Accrual gives you that accurate period-by-period picture, but yeah, it's a little more complex. It also tracks who owes you money and who you owe money to. And this last one is huge. Accrual is the one that's compliant with major accounting standards, which is a must for most growing businesses. So who uses which one in the real world? Well, the cash method is great for really small businesses, freelancers, maybe a consultant who gets paid right away. But honestly, most companies you can think of, especially any company that has inventory on a shelf or sends invoices to customers, they're going to be using the accrual method. It's essential. So the next time you look at a financial report, for your own business or for a company you're looking at, ask yourself, what method are they using? Because as we've seen, that choice completely shapes the story being told. The real question you have to ask is this: is your accounting just a simple diary of your cash, or is it telling you the real truth about your business's performance?